Okay, we're going to do a new example now in order to finish up these slides, which the slides are bringing a new example. Let's see what it is. The same Lori and John, she's asking for more trouble. Come back, again, the copyright infringement here with LL Bean, and they're 50-50 owners. Lori contributes the same cash that she did before, and John, this time, instead of land, he's contributing equipment. The fair market value of the land is 100. It has an original cost of 180. It's been depreciated down to 51,840. To get to 51,840, here's the amount of depreciation that's been taken. This number, I challenge you to tell me what this remains. Not remains, what its name is. What do we call that? That's right. We call it the adjusted tax basis. When this equipment, I should say, is contributed to the partnership, it will be done so in a tax-deferred exchange method, which ought to signify to you, if there's tax deferral, we're going to have carryover basis somewhere. Somewhere along the line there's going to be carryover basis. And that's exactly right. Just like the example we did where John contributed land. The only difference here is it's a property that depreciates. Now, the value of the property is important. It's $100,000, and the reason that's important is because we learned that the value of the property is how it's going to be recorded on the books for book capital. Not for tax, but for book. So let's see what happens. In essence, because Lori's cash becomes part of the partnership and the agreement's 50-50, John is actually getting a share of that cash. It's true, Lori's getting a share of the equipment in the way they worked their agreement. Lori didn't put in her agreement the suggestion I made at the end of the last video that she get her money back first. She left it where it's just 50-50. And as a result, she gets part of the equipment and John gets part of the cash. So it's really, like this slide says, it's as if she purchased one half of the equipment with the money she put in. And since she did that, what the slide tells you is that she needs to be allocated the tax depreciation. But even if you didn't know the rule that's being described here, which is a rule in the regulations, even if you didn't know that, but you followed the book capital accounts and the tax capital accounts to their end result, you would wind up getting everybody where they need to be by making those two capital accounts, the book capital and the tax capital, come to agreement at some point. Let's see. Here's the analysis. Let's look at Lori. Book based on cash brought in. Same as tax, cash is cash. For book purposes, the equipment came in at a value of $100,000. Recall? And it's going to be depreciated over 5 years, $20,000 a year. So she gets, it gets depreciated. What were the rules for depreciation? The property has 2.5 years left. Its value is 100, has 2.5 years. So that's 40,000 depreciation a year. This is just book purposes now. So the total depreciation for book is 40 per year until fully depreciated in the third year. 2.5 years left for $100,000 on book. So this slide actually shows it. So for book, her depreciation is 20, and John gets the other half. But for tax purposes, we're going to give all the depreciation, or at least most of it, to Lori and some to John. What's going on? For tax purposes, the amount of depreciation allowed, this year for tax, it's a carryover basis, it's carryover depreciation. And depreciation would have been in the hands of John, and it stays the same on the carryover basis idea. It stays the same in the hands of the partnership So it has a depreciation of 20,736. 20,736. The depreciation needs to be allocated to Lori. If you're not sure why, you'll see why when we do the book capital to tax capital comparison. And what happens is that we can only give Lori the depreciation from here, up to the extent that we gave her for book. We can't exceed book. So the book was 20, so we can only give her 20. The difference goes to John for the time being, and here's how it looks. Book purposes, 20 to Lori here. Year 1, 20 to Lori there. Year 2, half a year's depreciation is left in year 3. All goes split, 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 50-50. If you add up these splits, this one here, here, and here, 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 and here, that depreciation comes to 100,000, which was the amount for book purposes to be depreciated over 2.5 years. So for books, that's what we did. For tax purposes, we're giving Lori as much depreciation as we can get. The ceiling rule, what's being demonstrated, ceiling rule is you can't give more depreciation to Lori than she has for book purposes. Is that Lori? No, it's John. Oops. Okay. You can't give more depreciation to Lori than she takes for book on a tax. That's the ceiling rule. John gets whatever depreciation that would have been on the tax return left over after specially allocating to Lori. Again, if you're not following it, let's just watch the capital accounts and see what magically happens. So after year 1, this is book. After year 2, this is book. And after year 3, the asset has been fully depreciated, and you can see that the book capital accounts are equal. By following this method, look what happens for tax. At the end of year 3, the capital account for tax, John is at 50 and Lori is at 50. Now we've proven why this method works, because we gave $50,000 of depreciation to Lori because she basically bought the asset, or half the asset when it came in. She bought it and she paid half the value, which is $50,000. So she got the $50,000 depreciation here, or I should say she got the $50,000 depreciation here for tax, and John took the leftovers. And again, the proof that it works out is that the ending capital accounts agree with the book capital accounts. The ending tax capital accounts agree with the book. Let's take a look at one more example to just sort of drive home the point. Here John brings in equipment. Again, the fair market value is 100. Basis is only 23,040. The equipment is going to be recovered over 5 years with bonus depreciation. The tax depreciation, that's how it was set up. So the tax depreciation is carried over. Look at the words there. The same slide before had these same words, so you can go back to the prior example and see the same thing. Book depreciation's over 2.5 years. That's the 100,000, and the depreciation carryover will be whatever it would have been for tax purposes. And for tax purposes in 1 year, this is what it was. For book purposes in the first year, this is the number. Again, describing what the essence of the deal is. Here's the book depreciation split, and here's what we do with the tax depreciation. Since it's not going beyond the 20,000, it's not exceeding the ceiling rule. So if we said problem with ceiling rule, not here. It's below. And so no depreciation goes to John. Here's how the capital accounts work out. Look at book, just as before. Bing, bang, boom. End up with 50,000. Same thing here. because it's all based on equal 50-50. 50 cash is here, equipment is here. That's what he brought to the table, worth 100. Gets depreciated for book only, and we end up with equal capital accounts. Now the depreciation for tax purposes goes all to Laurie. Nothing here. And yikes, at the end of the day, we're not in agreement. So we have to rectify that. And that's what the regulations allow us to do. The way we cure it, that's what it's going to be called, a curative allocation, is in the future, we're going to allocate more income to John, potentially, or more losses to Laurie, so that we'll eventually get these two capital accounts to agree. Let's see what we wind up doing. Well, we gave more expenses to Laurie. That's what we did. We gave her more expenses. Depreciation from other assets or other deductions. So this is what's known as special allocation. Partnerships can do this. They can specially allocate, not according to their percentage agreement, but according to the tax regulations, so that the capital accounts will become equal. Let's see over time how it works out. Book again down to 50. Tax, this is the actual depreciation. And in the green is the manufactured special allocation. I don't mean manufactured in the sense that the deduction didn't exist. It's a real deduction, but it's specially allocated to Laurie until she gets down here. And the result is this third year is the only year that we're sharing depreciation for tax purposes between Laurie and John, because we now have them equal to the book capital accounts as they were equal and totally in sync. That's really cool. The result is, if you look at it, is that Laurie will have bought the equipment, or at least half, for 50, gets depreciated over 2.5 years. 1 year, 2 year depreciation, 3 year depreciation, adds up to the 50. The 50 that she paid for, its useful life was 2.5 years, so in 2.5 years it's fully depreciated. On the other hand, John sold the equipment to her, or half the equipment. If Laurie bought half, John sold half. So if he sold half, what's his gain? Well, let's take a look. His basis, what was his basis? His basis was 23,040. Let's see if I can remember that. 23,040. Its value at the time, we're told, was $100K. But she, or maybe the way to say it is, but 23,040 is the carryover basis, and it's as if John sold the property to the partnership. It's as if he sold it for nothing. No, not for nothing. He sold his half for $50,000. So if he sold his half for $50,000, it means that somewhere along the line he should recognize a gain. How much the gain would be? It would be 50,000 less 23,040. And we're going to pause here anyway. So I redid the slide here to make sure it's easier to see. John's tax basis was this. He really sold half of it for the fair market value, or half the cash that Laurie brought to the partnership for $50,000. The gain, I was just doing the math wrong before, the gain is $26,960. If we hadn't done anything that we're going to now look at over here, if we hadn't done anything, the capital accounts for tax purposes would have been out of balance. As you can see, they're not in there, and the reason they're not in there is there was a what we call a curative allocation or a special allocation to fix the disparity in the capital accounts, and it was done each of the 2.5 years by allocating the same depreciation that we specially allocated to Laurie, allocating it to John in the opposite direction, meaning it's income. So we're basically creating income to John. Well, and we're not really creating it. We are creating it on the books. This is all income to him. The total of these, now this is where the magic comes in, because you're not going to believe it. The total of these special allocations of income, let's see what it adds up to. I'm doing this the old-fashioned way. I'm going to add it wrong in front of you too, which is another neat trick. We have one more year, the 5,392, which gives us keep in mind 26,960, this number. There it is. There's the number. So he's basically, through this special allocation, recognized the gain as if he had sold half of it to Laurie, because in the agreement, she now owns half and he owns half of her assets. If you're not following, let me just show you one more time. She brought in cash of $100. Her agreement, it didn't have to say this, but her agreement, this is Laurie, this is John. He brings in equipment worth presumably $100. Their agreement says they'll share in everything. The agreement didn't have to say that, but it's saying that. So if that's the case, it means that the day that John has walked in, $50,000 of the cash now belongs to him. It's as if he sold the original equipment for $50K. So he's going to have to recognize that gain over time. Doesn't have to do it right away. It's still a tax-deferred event. But over time, through the allocation of depreciation, we magically get to where their capital accounts equal. After this, there's no reason to do anything further. We're done. We've got them equal. We keep them equal the rest of the way. That's how it works. It may be confusing. We'll keep the process going and see if we can look into the real things that you need to know about versus the things that just have to appreciate. Talk to you then.